In the 4 videos that I've created, which was the first video of identifying and applying the order block, the second video was institutional price levels, the third video was price imbalance, which is liquidity voids and fair value gaps, and the fourth video I showed you was the institutional order flow, the source, and the breaker. So without further ado, I'm going to continue here. So this is EU. I know a lot of people like to trade EU, and generally this is the most traded pair. It's the highest liquidity pair in the market. And so let's just start basically here by seeing and marking up the recent high and recent low of where price rallied and fell from on EU. So let's just mark up the source over here. So we remember that the source candle is the highest candle inside a peak formation high or a peak formation low. So this was the PFH, the peak formation high of this rally, okay? And the last order block was this candle over here. So this candle is a bearish candle and it was engulfed. Although this was a candle that was some indecision here, it took 2 candles, but you can see that this large move to the upside created with 2 candles this order block, and you can see how price rallied up. Okay, so this blue box indicates our source over here. So we're just going to call that our source, and we can see that if we put our price over here, that is an institutional price level that price rallied from and created our source for us, okay? This was the last order block, okay? So price rallied up, and if we had followed our institutional order flow, so here is the bottom of this area over here. So we're following our institutional order flow upwards, okay? And if we had followed it downwards, this candle over here would have been our order block, our bearish order block, but because price closed above this order block, this bearish order block, we now say that that is the breaker for this move at the bottom, okay? So we will also have a source, which is this candle, the biggest candle at the peak formation low. Okay, so that is our source. Okay, we also have a bullish order block over here. And as you can see, the red block indicates our bullish order block over here, and the candle that created the peak formation low is our source, which is the blue box over here. So peak formation low, and that is our source. Then that was our breaker, because that was the last bearish order block before the down move. So let me just move these boxes aside here so you can all see price intersecting over here. So here is our source. This candle over here is our source. That candle over there is a bearish order block for this down move. Price then broke out and created this as our breaker, our yellow box as our breaker. Then we had our bullish order block inside of our source and inside of our breaker, all 3 intersecting. And those are the kinds of intersection we like to see to give us additional confirmation that we have a good trade. So price rallied up and then created this order block over here, okay? Then again, price rallied up and created this order block over here, which was responsible for this high. Now notice that when price rallied up and rallied back down, we are still trading inside of this order block over here and this order block over here. So from our source, we've traded up, created our first order block, our second order block, and now our third order block, okay? And as additional, we can see that when price traded up, this over here is our institutional price level. So price rallied into the institutional price level and bounced. Where did it bounce to? Well, basically our institutional price level of 200. So bounce up into the 500, rejection from the 500, and it is now maintaining price inside of our order block and our institutional price level. Again, another order block was created of this candle over here. Price then rallied up. Where did it rally up into? And we can see that that is another institutional price level right over here. So that is our institutional price level. Price rejected down. And you can see that although this order block here was formed a bearish order block, we are following the institutional order flow because it is bullish. Okay, so price rallied into our 800, rallied, shot down past our 500, bounced off of our order block that was created over here and over here, and rallied back up. Now it's still trading above our institutional level of 8,500 and within our 800 institutional price level. Again, another order block over here was created for this candle over here. Price rallied up, and you can see there was a rejection at the 800 level. Price still trading inside of our order blocks over here. So you can see that all of these order blocks have been respected. And again, another order block was created over here. Price rallied up. Now, you can see there's a lot of order blocks here, but it's important to remember that for the purpose of keeping the chart clean, for the purpose of not confusing yourself, you don't really need that many order blocks. So as long as you have at least the last two order blocks, then it doesn't actually matter how many you have, because we know that when price breaks a strong order block, we can say that price institutional order flow has changed. Okay, so price from this order block over here rallied up into our price over here, and you can see there was some hesitation at this area, and we created another order block. Now you'll notice that over here is an institutional level of 500. So we rallied up into our 500, little bit of rejection over here, and created another bullish order block, rallied up into our 200 institutional price level. And you can see that long wick, there was rejection of price and basically rallied back down into our institutional price of 500 over here. So that is our institutional level of 500. And this was the last strong order block before this move upward. And you can see price traded over here and broke down. So when price broke down, this immediately became our breaker. Okay, so we have a breaker at the top, and now we have a breaker at the top, which was broken and created. And which candle? That candle over there closed below it. Now, sometimes we can say that there's price indecision over here, and we need to add an institutional level. Our next one would be the 200 institutional price level. So we need to rather use this order block over here. So here is a bearish order block inside of our breaker over there. So that is a bearish order block. Price then went down, and this candle, this line over here that I've drawn, represents the candle that created our breaker. Because remember, there was price indecision over here and price was ranging, and that is the candle that created our breaker over there. Okay, so we can see price then hesitated at this level over here. If we notice, what level is this? This is our round number figure over here. So there is our round number figure, and price maintained this level, wicked into our order block over here. And if we just zoom in a bit over here, we will actually, I'm just going to remove a little bit of this clutter. We can see that this over here, from this wick to this wick, there's actually also fair value gap right there. So that is an FVG, like I've showed you in a previous video. So price wicked in there. It also wicked onto our order block, and price then fell. Well, where did it fall to? It fell into our 200 institutional level and traded between our 800 institutional level. And if we zoom out here, so we've had our source at the top, we've had our source at the bottom, and generally we trade from source to source. Now, retail traders will call this support and resistance. There is no support and there is no resistance based on the fact that price is not random and price is manipulated by the institutions. And we are trading in line the best way we can, as to not use the average YouTube videos that would show us the trend lines, the harmonic scanners, EMAs, all of that. We are following price action, and we are using price because why? Well, price is what we trade. We buy and we sell price. That is essentially what we are trading. So our trend line is not going to tell us what price is going to do. Price is going to tell us what to do, and the chart is telling us how to trade. And we are just following what the institutions are doing with the institutional order flow. Okay, so when price rallied from this source into this and created this source, okay, that's not a trend line, I'm just showing you the direction. Price then rallied down into here, okay? So when price rallied down, where did price rally into? Well, let's pull our breaker across over here. So remember at the bottom, there was this breaker over here. And also we have our source at the bottom. And also we have this bullish order block, okay? So this moved to the downside, wicked into our breaker over here. Because why? We like our breaker and we like our source to be tested. When it's tested and rejected, then we can have additional confirmation as to why to take the trade. Okay, so we are trading from source to source. So notice how here price bounced off of our breaker over here, but price did not close or even try to wick through. So we can already see what price is doing. Look at this. If we just add our institutional level over here of 800, we can see price rallied into our breaker and basically did not do anything except bounce off of our breaker. So when price rallied off of our breaker, we are looking now for buys. So we were looking for sells from our breaker because price had tested our order block over here, closed this fair value gap, and we were in the sell because price had tested. So when price came down, we trade from source to source. So we would have entered our trade somewhere at the top over here, maybe at the fair value gap or this bearish order block over here, ridden the wave down, and we would have wanted to possibly take off our trade when we get to about 100 pips, because when we get to an institutional price level of 800, we're testing our breaker, we're testing our source. Well, then the trend might reverse. So we just take the profit that's on the table that the market is giving us. We don't want to be greedy. So we take our profits and then we look for another confirmation as to why to take the trade. Okay, so in another video that I'm going to create on YouTube, I'm going to show you how to use the Fibonacci retracement tool, which is another concept to add as an additional confirmation of why to take the trade. But for now, I'm just going over what I've showed you in the video. So all I'm doing is following the institutional order flow up here into the source. Institutional order flow changes when we create the breaker over here. We test our breaker, price rallies up. We want it to test, and we take our trade following the institutional order flow and our order blocks. So if we look on the right side over here, we will see that additional order blocks are now being created. Okay, so notice how these order blocks also intersect with institutional price levels. So at the bottom over here, if we pay attention to our 800 level over here and our 200 level over here, we will see that this order block over here was created. Price then rallied up, wicked into our 500 and rallied back down. So we know that this order block is still valid based on the fact that, sorry, this is actually the order block, because I've showed you that when it's a bullish order block over here, it took more than 2 candles, but we use the wick of the candle that created the order block. Because it's bullish, we use the wick and the top of the wick of the bearish candle over here. So that encapsulates our order block over there. Okay, so price rallied up into our order block, rallied up again, rejected our 800 price level over here, and rallied back down into our institutional price level of 800, retested our breaker, and actually, if we zoom in over here, we will see that there is actually a fair value gap as well. This is a fair value gap over here because there was no wick that closed price over here. These were the lowest wicks. These wicks over here were the lowest, and this was the candle. So there was imbalance in price, and when price came to that level, we see, so let's just zoom out here and pull our fair value across over here. We can see that we closed our imbalance of price, we tested our breaker, created a bullish order block, and now we are waiting for a buy. So each time price is testing this area over here, we are seeing another order block being created. So I draw it in red because that is an order block. Okay, so price is still inside there, and you can see although price closed below it, we are still inside this other 4-hour order block over here. So this is still a 4-hour order block, and price rallied from this area. Again, we created another bullish order block over here. Okay, so price rallied up, and that is an order block. And if you see over here, there's another order block over here. So price rallied up. If we pull our source across over here, we will see that our source is being tested. Okay, now notice also that there is a fair value gap over here. Well, actually, this one is a liquidity void based on the fact that it is a large move upward and there is big in price imbalance. So that is actually a liquidity void. Now, based on what I've showed you about imbalance in price, we tested our source. And if we pull our breaker across over here, there's our breaker from our previous. We are waiting for a sell confirmation. But because there is a liquidity void over here, and if I measure this liquidity void from there to there, there exactly is our 50%. So that this price level over here is our 50%. I'm just going to make that purple so you can see that that is a 50% bounce off of our liquidity void, even though our candle over here, this is our order block that rallied price back up, we needed to close this gap at least 50%, and then we see the rally. Okay, so when we see this rally over here, we can already see that here is the candle that bounced off of our 50% liquidity void and created an order block. Okay, now notice when this order block pushed price up, there was another fair value gap created over here. So when price rallied up, still testing our source over here, you can see our source, we're bringing them across from the previous price. It wicked into our fair value gap and rallied up. Now we know that although it took more than one candle, this is still an order block. Okay, this candle over here is still an order block because there was a large move to the upside, and it was this wick over here closed about, let's say, 80% of this fair value gap over here, and price maintained its direction upwards. Again, another order block was created. So this candle over here encapsulates our order block. Again, another order block was created. Okay, so you can see how these order blocks are now starting to create a bullish momentum, and price is starting to move up. Okay, so again, another fair value gap has been created over here, and as you can see, no price has tested it, and we are still maintaining a bullish order flow. So price has created an order block, rallied up. Where did it rally up into? So I'm just going to create this as a red line, so you can see that that is an institutional price level of 200 over there, and you can see that price then rallied down, maintaining our order block over here. Okay, so when price rallied up, it created another order block over here. So this is our order block. So price has not broken our order block. Price has not closed our order block. We are following the institutional order flow upwards. And again, another order block was created. There was actually one order block over here on this candle and another order block on this candle over here. You can see that we are still bullish, and this candle, although it looks like a bullish order block, there was no real move to the upside. You can see that there was rejection. So don't be fooled by candles like that look like order blocks and they're actually not. This black candle being engulfed by this one does not necessarily mean that that is an order block. An order block needs to see a move to the upside or the downside, depending on if it's bullish or bearish. Okay, so again, we can see that this candle over here, this candle over there, is not the order block. This candle over here is the order block, because that is where it's coming from. Okay, so this is basically following the institutional order flow, using the source, using the breaker, and using bullish order flow in the case of EU to follow the order flow. Okay. Anyone have questions? I see Mayowa, you have a question? Nobody got questions? Yes, Martin, you have a question. You can put your mic on if you want.
Hi, Darren.
Hi, yes.
Okay, so on the order blocks that you've already marked, are they traded on the lower time frames, or how do you trade them?
Well, this specific, we are following the order flow specifically on the 4-hour chart. but time frames are fractal. So what is essentially that meaning? So essentially what that means is where you see order blocks appear. So for instance here, this is a daily. Let me just clean this up here so you can see. This over here is a bearish order block, right? So this is a bearish order block, and you can see price maintaining that level. Okay, so this is a daily chart, and over here is another daily bearish order block. Okay, and you can see how price rallied into it over here and rejected down. Price rallied in, rejected down. Price rallied in, rejected down, and eventually price just broke out. Okay, now order blocks have to be traded on the daily time frame for longer than they would be traded on a 4-hour time frame, based on the fact that the daily is stronger than the 4-hour. So as you go down to say the 1 hour, there are still order blocks and you can still follow order flow, but the order blocks created on lower time frames are less effective than higher time
Yeah.
frames.
Huh? Okay.
Anyone else? Sir, about the source and break, I don't really get how to make them. Well, basically the source and the breaker, the source is the top of a peak formation high, or the source is the bottom of a peak formation low. Okay, so that is essentially the source. It's the top peak formation high, wick of the candle, and the peak formation low, the wick of the candle, encapsulating the entire body. Okay, notice how I encapsulate the entire body of the candle. The breaker is the last order block, a strong order block. You don't want to be fooled by weaker order blocks. A strong order block. You can see that this was the last order block for this source over here. Price then rallied up, created our source over here. When price broke, so here is where price broke on that close of that candle. So when the candle closed over there, it came in to test our breaker. This is our breaker. And then rejected down. Nicholas, you have a question?
Hello, sir. Can you hear me?
Yes, I can.
Yeah. My question is it good to take a trade immediately after an order block?
Like as soon as it's created. So what you're saying is, let's look at this pair here. This is GU, right? So when this order block is created over here, this order block here, what you're saying is, as soon as this order block is created and this
Hello?
candle over here closes,
As soon, yeah.
you
That
want to take a trade
is
there.
it right?
No, you
Okay.
don't do that. You don't need to do that. You need to wait for price to test that order block again and use the other confirmations I've given you, like the fair value gap. Because if we zoom in here, so this is a bullish order block on GU.
Okay.
Notice also that there's actually a fair value gap from that wick to here. So there's a fair value gap, a small fair value gap on the 4-hour, but if you look on the 1 hour, it can not be a fair value gap. But on the 4-hour, the data represented to you on a higher time frame is more effective than a lower time frame. So we can see GU rallies up. Where does it rally up into? Well, that's our institutional round number figure over here. Price then rejected and bounced off of our order block over here. Okay, so price rallied from our order block. Okay, and if we see here that this is actually an institutional price level of 800 over here, and that is the purpose for the rally. And another one over here, we can see institutional price level of 200. So not only do we have an order block, a 4-hour order block over here, price rallying into our institutional price range, rejecting, you would want to enter over here when price retraces back. Okay, so this would be your entry. You don't enter when the order block is created. You rather be patient and wait for it to come back and test, close the fair value gap if there is one, and then take your trade.
Okay, sir. Okay, sir. Thank you very much.
Hello?
Martin, you asked, is it possible to trade one currency, or is it too risky with this strategy as it makes so much sense? I wouldn't recommend, because you're obviously doing a lot of work on the charts. You don't want to trade. I personally don't trade more than 7 pairs. But as a new person learning this concept, I wouldn't trade more than 2 pairs, based on the fact that you're going to get distracted because there's multiple time frames you're looking at. Different order blocks, fair value gaps, price imbalance, liquidity void. So all of that can distract you. So it's possible that you'll get distracted when there's too many pairs. So rather start off with 1 or 2 pairs. And when you start to get accustomed to the strategy, then start to move into maybe more pairs.
Hello?
Anyone else got a question?
Hello?
Okay, so I've covered the institutional price levels and how price reacts off those levels, and marking up your, let's just clean this chart up over here. Fair value gaps. Fair value gaps are basically just voids in price, emptiness in price. So here is a fair value gap over here when that price closed, and to this